Welcome to PIMCO Pod. In this episode, we discuss how U.S. companies are absorbing tariffs by cutting labor costs and increasing prices modestly. Stay tuned after the conclusion of the podcast for additional important information. U.S. labor markets, a release valve for tariff pressure by Tiffany Wilding. The Trump administration's tariff policies have raised the effective average U.S. import tariff from under 3% in 2024 to approximately 11% actually being paid today, a jump not seen since the 1930s Smoot-Hawley Act. Data source is the U.S. International Trade Commission, or USITC. With so little precedent of tariff hikes on this scale, we've relied on historical studies of smaller policy shifts in industrialized economies to estimate near-term effects. This analysis suggests that without a major currency adjustment, businesses typically pass price increases onto consumers, which in turn tends to reduce real disposable income. While this finding is a helpful starting point, now that we have more months of concrete economic data, we are gaining a better understanding of the transition taking place in the U.S. economy. In our 16th of July 2025 edition of Macro Signposts, we analyzed various data sources that suggested corporate profits appeared to be absorbing the bulk of the additional tariff costs. Data released since then have changed that picture somewhat. Although price pass-through has still been slower and more uneven than history would suggest, it now looks like many companies have managed this transition through careful management of other costs, including labor costs, which has allowed them to maintain profits. Regardless of whether the economic adjustment is due to labor cost declines or price level increases, the impact on real household incomes would tend to be negative in aggregate. However, the distinction between these two economic drivers matters for inflation expectations and monetary policy. A milder price level adjustment paired with greater labor market impact could widen the scope for Federal Reserve rate cuts and accelerate a return to neutral Fed policy, which is estimated to be around 3%. Based on the Fed's median long-run rate projection released in June. Indeed, recent labor market data are enough to tip the scales in favor of cutting interest rates despite still above-target core PCE, personal consumption expenditures inflation. Corporate profit data highlights how companies are coping. According to the U.S. National Income and Product Accounts, NIPA, published by the Bureau of Economic Analysis, BEA, U.S. corporate profits held up remarkably well in the second quarter, despite one of the largest tariff hikes in a century. Data from Q2 equity earnings suggest that rising profit margins for larger companies have helped offset declining margins for smaller companies. In aggregate, companies have defended profits despite limiting end-user price adjustments by managing labor costs, and to a lesser extent, other costs. A closer look at the details of NIPA profits suggests that higher volumes drove some of this performance. The economy was still benefiting from a surge in activity ahead of tariffs, which lifted service industry production connected to trade. However, on a per-unit basis, corporate profits of non-financial businesses were up 1.8% in the second quarter, despite a 7.5% quarterly annualized increase in production and import costs from tariffs. Companies in aggregate defended their profit margins by increasing prices somewhat, according to the same dataset. Per-unit prices within the business sector increased roughly 1% annualized. However, the large offset was a 2.3% decline in labor costs. This is also slower than the rate of pass-through witnessed after washing machine tariffs were implemented in 2018, for example. Import price data still suggests a small offset is probably coming from price reductions by foreign producers. Recent labor market data also support this analysis. The BLS's newly released preliminary revisions to reported employment by establishments suggest that for the trailing 4 quarters ended March 2025, actual employment was over 900,000 below initial reports. There are good reasons to believe that the establishment survey is still overestimating payrolls, which implies the 6-month moving average of monthly changes could be closer to flat, versus the currently reported 64,000. And also implies the 3-month moving average of monthly changes could actually be down 30,000. It's not just tariffs that are affecting the economy. Other factors could also explain why companies are relying more heavily on labor cost savings and less on price adjustments than historical precedent would suggest. 1. Changes in immigration policy have effectively halted U.S. labor supply growth. Over the past few years, foreign-born workers have made up the majority of the growth in the U.S. labor force. Out of necessity, companies could be finding ways to reduce their reliance on labor. 2. Technology, including AI, is reshaping the global economy. Tech-related investment added an estimated 0.5 to 1 percentage points to U.S. growth in the first half of the year, according to our analysis of August BEA data. Early evidence also suggests that AI is starting to reshape the labor market. Younger workers, who are more likely to be displaced by AI, are having a more difficult time finding jobs. The unemployment rate of U.S. workers aged 16 to 24 is currently 10.5%, up from a pre-pandemic low of 6.6%, while the unemployment rate for all other workers is 3.4%, up from a 2.8% low. 3. The offsetting tax cuts and credits from the One Big Beautiful Bill Act should begin to counter the drag from tariffs in the first quarter of 2026, by our estimates. But the interaction among taxes, tariffs, and AI investments means that not all companies will benefit equally. Companies that are more capital-intensive and have the budget to invest in AI are the relative winners, and they appear poised to take market share from labor-intensive businesses that are falling behind. While claims on unemployment insurance suggest that outright layoffs are still low, the environment is likely to challenge the business models of many companies. What does all of this mean for Fed policy? The Fed must navigate a complex set of policy shifts that affect both supply and demand and interact with technological transformations. While it's still early days, these factors appear to be weighing on real U.S. incomes through a larger labor adjustment than past tariff hikes would suggest. Looking a bit further out, whether higher productivity gains can offset lower labor supply from immigration policies, and whether a broad investment pickup can offset more sluggish consumption are key issues for the U.S. economic outlook. However, over the next several months, with the Fed's policy rate still well above its estimates of neutral, plus the changing balance of employment and inflation risks, we see an argument for interest rate cuts as the Fed, companies, and investors gain a better understanding of how the economy is navigating all of these changes. Thank you for listening. That was U.S. labor markets, a release valve for tariff pressure. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.